By keeping private equity as a minority investor, you keep the shared ownership and the fan experience at the center of everything that's going on and creating the best outcome for them while also trying to solve for the challenges that these franchises have faced themselves.
Welcome to The Alternative Investor, the definitive show for investors seeking private alternative investments. Here's your host, Matt Johns.
Today, I had an exciting conversation with Mark Wade, partner at CAZ Investments, an investment firm that works alongside investors to source, diligence, and manage alternative investment opportunities in both public and private markets. Over the last decade, CAZ has committed approximately $7 billion to private market investments, becoming one of the largest allocators of private equity in the world. Now, after spending 4 years on the University of Virginia's lacrosse team, where he won a national championship in 2006, Mark spent nearly 10 years working in the healthcare industry at Johnson & Johnson and then St. Jude Medical. Then after getting his MBA from Rice University, he started his journey in private market investments with CAZ. Mark works closely with family offices, investment advisors, and institutions to co-invest with the firm and is specifically responsible for sourcing and evaluating investment themes. Notably, he's been actively involved in their private equity investments in professional sports. Now, this is an area that I find fascinating and wanted to get a deeper understanding, and Mark definitely delivered. I'm so excited to share it with you. Welcome to my conversation with Mark Wade. You played lacrosse at Virginia, and you were there for the national championship in what, 2006?
That's correct. Yep.
And how was it? You got the ring on you?
I don't have it on me, but I do keep it at home. My kids like to climb up on the shelves and grab it and run around with it, which gives me a little anxiety when they do. But it's fun to talk about. It was a great experience.
Eventually, you went through a few things in your career, and you ended up at CAZ, and it looks like you just had an incredible time there, going from where you started to where you are now. And I understand Tony Robbins is one of the owners there.
That's right. Yeah, Tony joined the ownership group a few years ago, and it's a real privilege to have him involved. He's been a great partner, him and his team. We work with a number of folks within his organization, but Tony's been very supportive, and the rest of the folks there with the Robbins group has been just fantastic.
Does he ever come for maybe a quarterly meeting or something like that?
You know, we actually get together with him at least once a year. We're actually going to do it next week. I'll be there early next week, meeting with Tony and his team for about 3 days, and we go through the whole business. What are we working on? Where we come from in the last 12 months? They've got board representatives as well, so there's lots of check in there. And it's very collaborative. I mean, I exchange audios with his team, audio messages quite a bit. Very collaborative. They're very helpful. They've got a lot of relationships, a lot of expertise. It's kind of funny because we're a firm that's known for a lot of different investment strategies, but GP investing is one of them where you invest in the manager, and we're usually the buyer in those situations. And we actually sold a stake. So the GP firm is now taking a GP investment, but that's another story.
What is it about CAZ that attracts both sides of the equation? What's your edge in this whole thing?
Yeah, I think ultimately this comes down to people, right? In the investment world, you don't make widgets. There's no production line. You might say it's the analyst room is the closest thing we have to that. So it's a people business, and people create cultures. And I think our biggest differentiator is our culture. It's the way we operate as a business. That culture is defined by our principles and our promises. And so anybody can get on our website and read those. Our principles are the guiding principles of the business. Every 90 days when our leadership team meets to go through a quarterly planning cycle, we go through and read those principles out loud because we want to remind ourselves of what are we doing, why are we doing it, and how are we going to do it. And then we have our set of promises, which are the promises that we make to one another as a team of how we're going to treat one another, how we're going to treat our partners, how we're going to treat our investors, how we're going to treat the firms we invest with. And so our principles and our promises are really the manifestation of the culture of the business. And those in turn lead to very unique and differentiated opportunities. Professional sports is a good example of that, but we do a lot of interesting things that some would call off the beaten path. They're not the normal types of even private equity investments. When you think about buying some general manufacturing business, that could be a great investment. But really what CAZ is known for is access to niche markets that are highly differentiated and unique. And I think that's ultimately the manifestation of the principles and promises, the culture, and the people of the firm.
And one of those niches that you just mentioned is professional sports. And that's become really prominent in the public eye, especially with the NFL recently releasing a statement that they're going to be allowing private equity to come into ownership of their teams in the league. And CAZ has been involved in this for a long time in different professional sports all over the world. Uh, so, what? How does private equity work in sports?
Yeah, so we started looking at this about 5 years ago, and that's because it's a new thing. I mean, very rarely in the world are you going to find something that's a truly new investment asset class. The investing world's been around a long time. There's not a lot of new things that have happened, but this is a new thing. In 2019, before that year, every league in North America, and generally my comments are going to relate to North American sports, which
Mhm.
are structurally different than sports around the rest of the world, and we can talk about that. But the North American sports had a rule in their bylaws that said every owner had to effectively had two legs. It had to be a person, a human being. You couldn't have an institutional pool of capital or investment corporation or something like that own them. And this goes back to the 90s when there were some high profile sort of flame outs of corporate ownership of sports franchises. They just didn't want to have it. The leagues didn't want to have it for their own branding reasons. And then and as time went along, leagues realized, look, we're leaving out a very large capital base that could be supporting the further growth of these enterprises. And their sports franchises are companies just like any other company you would think about. They require capital to grow, and every company is constrained by the amount of capital that it has available to it with which to grow. And sports is no different than that. And
Mhm.
so in 2019, Major League Baseball went first. They amended their governing document to allow for a quote unquote covered fund. And a covered fund is a private equity fund that meets very specific criteria. You have to thread the veritable needle of conflicts of interest and other restrictions, structural restrictions, to be able to invest in the franchises. But so long as you could do that, you were allowed to invest into the franchises themselves. And then you had National Basketball Association, NHL, MLS followed suit. And of course, the last one most recently to do it has been the National Football League. And so it's a very unique investment, and we're going to, I think, dive a little bit into that today. But structurally speaking, you're talking about a select group of private equity firms that have effectively been blessed by the league level regulators, the commissioners, to buy minority interest in a select group of franchises. They can't go out and own the entire league. They're only typically allowed to own a certain amount of franchises and a certain percentage of those franchises themselves.
Now, what would be the purpose of just maintaining minority control over teams and not having majority control with private equity, or I guess, what did you say, collective investment interests?
These It's a really interesting question. These assets are very different than a normal company out there that a private equity firm might want to own.
Mhm.
Nobody thinks of the local bottling manufacturing business as a community asset that the people of that community have a shared interest in. Maybe they should, maybe they shouldn't, but they don't. Everybody thinks of the local sports teams that way. So there's this sort of community ownership feel that the owners are very cognizant of, because ultimately the customers of their business are the fans. And I'll come back to that as one of the strengths of this investment. But you have to keep your fans happy. You have to keep them engaged.
Mhm.
You have to keep them hopeful about the team. And if you allow a private equity firm to come in and own one of those franchises, if you have the wrong private equity firm, they might do things for financial gain that might ultimately hurt the fans' experience,
Mhm.
right? Or hurt the team's performance. You see this where some teams spend a lot of money to have the best team. I mean, the Dodgers just won the World Series. They've got one of the highest payrolls in the league. The Yankees also did the
Mhm.
same thing. So they spend a lot of money to have a great fan experience. And all the Dodger fans are very happy that they paid Shohei Ohtani $700 million, right, to come in
Right.
and play for the team. But the opposite might be true when you say, look, we're gonna fire sale the roster. We're gonna run the team at the minimum payroll for the league. We're gonna create as much margin as possible. The team, their performance come as it may, we're not gonna worry about that. We're just gonna worry about us making as much money as possible. That's not a good solution, right?
Uh-huh.
And so by keeping private equity as a minority investor, you keep the shared ownership and the fan experience at the center of everything that's going on and creating the best outcome for them, while also trying to solve for the challenges that these franchises have faced themselves.
That's a terrific answer. Now, from the other side of it, though, what is the allure for the investors? Because obviously, there's the mystique of being a part of these very publicly facing teams. But what is the allure for investors in general?
I think if you take the emotion out of investing, it doesn't matter what you're buying, whether it be a technology stock, a U.S. Treasury, or a sports franchise. investing, the academic effort of it, the theoretical effort of it, why we do it ultimately, everybody should buy an investment for one of three reasons. It's only three reasons. That investment, when you add it to a properly constructed portfolio, should either increase the expected returns of the portfolio, decrease the expected volatility of the portfolio, and decrease the correlation of the portfolio to itself. So increase returns, lower the risk, lower the correlation. Well, the reality is there are very few assets in the world that accomplish those three things. There's really not that many. There's plenty that do two out of the three. You can buy a UST bill, and that typically will reduce the correlation of the portfolio, and it'll decrease the volatility of the portfolio, but your returns will come down as well. So you accomplish two out of the three, not three out of the three. If you go back and look, statistically speaking, sports has accomplished those three things. So on a relative basis, if you just look at an index of North American sports franchises over the last 20, 30, 40 years, they've compounded at a rate of return somewhere between 16 and 18%. Well, that's like the US private equity buyout index. That's like private equity returns. That's exceptional, right? When the S&P 500 over that same time frame might be doing high single digits, low double digits. So you're increasing your expected returns by adding sports franchises in. Volatility, right? This is what's interesting. A lot of folks don't realize, and it's one of the reasons why, the leagues have opened up to investment from institutional capital, is you can't lever up a sports team. The leagues will not permit this. There are debt to capitalization ratios that cannot be violated on the franchise level, such that it protects the value of the asset by not allowing bad times to come in, or interest rates going up to really hurt the outcome of the investment, have to fire sale something or default and go bankrupt. That's a bad look.
It preserves the integrity of the league, right?
That's right. And so if you think about volatility as a measure of leverage, well, that same US private equity buyout index I talked about before that generated the 16 to 18% return, it's running at about 40% leverage, right? That's about the average there. The S&P 500, that's about 20%, okay? Sports, about 9. So you've got the same level of return that traditional private equity has generated, but you've done it with a quarter of the leverage. That's a good measure for volatility, meaning there's not that much of it. So that sort of checks the second box. And then the third box about correlation, this is what's really astounding. If you look at the correlation of all the leagues together to the performance of the S&P 500, it's about a 0.14 over the last 30 years. Well, I'm not a statistics guy. I had a hard time in my first data analysis class in graduate school. But I've learned since then that a 0.14, that's a very low correlation ratio to any type of a beta. And so if you're increasing your expected returns, you're lowering your volatility, and you're decreasing the correlation ratio of the portfolio to itself, well, that's really great. And that's why you see really wealthy people who are very sophisticated investors. That's who's buying sports franchises today, right? These are high-powered financial minds that are typically private equity founders, hedge fund founders, or executives backed by private equity who understand how the system works. That's who's buying sports franchises today when you see a control sale.
And why do you think the correlation is so low, or is so low for these franchises?
What it comes down to is the inherent nature of the customer of sports. So let me maybe put it to you differently. Think about shaving with a razor, right? It's probably true that the first time you got a razor, you probably got it from your dad, right? It's the same razor that your dad gave you, or whoever the fatherly figure was in your life when you started shaving. Well, imagine if that razor, every fourth time you used it, it cut your cheek or cut your neck pretty significantly, and it did that every 4 times. Well, what would happen? You'd probably throw that razor away and switch, right? You'd probably get a different one. But you wouldn't keep using it just because, well, this is the razor that my dad likes, and I really like this razor, and I like its colors. The utility of it is what drives the usage. Well, that's what we do with sports, right? Like I'm a New York Giants football fan, right? It's been a long time since the Giants have been good, but I'm still a fan, even though they're 2-6 right now. And in the dumps, because why? Because it's my family's team. My mom and dad grew up in New York City, and so I lived at West Point when I was a kid. My dad was in the Army, and so I grew up going to Giants games and hearing stories about Giants games. And so I'm a fan of the New York Giants, even though I live here in Houston, Texas. So the point there is, like, you have this very inelastic, to use an economics term, you have an inelastic demand for the product that professional sports franchises produce, right?
Huh.
Meaning like you could see high performance, low performance, fans still show up and they end up paying to come to the games. Obviously, the better the performance, the more fan engagement there is, but there's a baseline there of people who are still fans. That's why you see people show up with the trash bags over their heads or the brown paper bags, and they cut their eyes out, right? They're still there. They're still paying for seats. So that lack of correlation is ultimately driven by a customer base that is still buying the product regardless sort of the outcome. And then if you think just more globally about what sports represent in our culture, right? And the unique place that they are, it's really the only thing today, and this really goes to our theme in investing in professional sports franchises, is cord cutting and the change in consumer behavior about how we're absorbing all the content that's out there in the world. I mean, I've got 4 little kids at home. We've got every streaming service you could think of. And I think for the volume that we use it, Disney makes us pay twice for Disney Plus, right? So we got all these streaming services. It causes this disruption now of where people are consuming content. But advertisers still want to reach people every day via live television. Well, there's one thing that people are stopping their days to watch live television for. It's sports, right? The statistic that we like to quote is in the year 2005, I think, 14 out of the top 100 most watched live programs were professional sports, right? Because you were watching things like The Office or Seinfeld
you couldn't
or
miss
Friends or whatever. And last year, Matt, it was 97. 97 out of the top 100 were live sports programs. So it when I talk about this unique place that sports play in our culture, I mean, the world is riveted by watching, game 1 of the World Series, Los Angeles Dodgers versus New York Yankees. That's why they had the best ratings they've had in almost a decade.
And my understanding is the revenue model is very skewed toward TV right now, and those contracts. That's why you can have an empty stadium but still have a profitable team. Is that accurate to say?
Yes, and this is the biggest change in your going from like whoever your parents' sports teams were to your sports teams today. It used to be an episodic game day revenue generating business, right? Where the performance of the team really drove attendance, which in turn drove concessions and merchandising and sponsorships and things like that, season tickets. And a lot of the revenue was derived from how many people showed up every day and paid for, the products that were produced on a game day. That's not the case anymore, right? This has become really an infrastructure like business in terms of long dated cash flows from contracts. I mean, the NBA just signed their most recent media rights deal. It's an 11-year deal, $76 billion. That number's set. It's not going to change, right? And it's fixed, whether one team wins or another team wins, whether 50% of the people show up to the games, 100% sold out. It doesn't matter. That number is fixed. And so as you think about the trajectory, and every league has a little bit of a different composition, right? You've got, on the one hand, you've got Major League Baseball and National Hockey League that have more of the revenue is derived from the local market than the national media rights. But on the other end of the spectrum are the NBA and the and National Football League that have more of the money comes from the national media rights and the national licensing, which is a really interesting dynamic.
Now, looking at valuations, how do you value these teams and how is that calculated?
Yeah, so you're going to value these assets, at least we think about valuing these assets, the way you'd value any asset. It really comes down to a discounted cash flow analysis that allows you to understand how much these teams are going to make, when they're going to make it. There's just a different component around what else comes into play here, right? And so when you think about any North American sports team, every North American, when you own, whether you own the Houston Astros or you own the Boston Red Sox or you own the Kansas City Royals or the San Francisco Giants, it doesn't matter, Oakland A's, every team owns a few things. The first thing you own is a pro rata share of the league level parent entity that has all the global licensing rights to baseball, basketball, hockey, football, soccer, it doesn't matter. And they're going to license those rights out in the form of media rights. There's national sponsorships, there's merchandising that gets done, right? All of that, it's an intellectual property licensing business that all of it hits that league level entity, and then it's distributed pro rata across the league, equal parts, right? So everybody gets their share of that. And then the next thing you have that you get to monetize is a protected geography. I sort of tongue in cheek describe professional sports in America. And there's actually an interesting article in the Wall Street Journal that talks about this. It's really like a cartel, right? It's a cartel, and you can talk about a cartel. Everybody thinks about drug cartels, but really oil cartels like OPEC. A cartel is a collection of market participants who come together to collectively bargain with suppliers and distributors to basically set it up so that they make money, right? And they fix their margins. Well, that happens in sports, right? And what I'm talking about here is every team has a protected geography that you own the exclusive rights to that sport in that protected geography, and nobody else can monetize anything related to that sport in your market, right? The Dallas Cowboys can't go to New York City and sell a licensing deal in New York City because that belongs to the Giants and the Jets, right? That sort of thing. So the first thing is you own this global, your pro rata share of a global licensing business. The second is you have a protected geographic area. And the third thing you have is this fan base, is this customer base. They're called fans. People forget what that's short for. That's short for fanatics, right? These people are crazy about what you do. And so that's an opportunity to monetize that as well. So when you think about valuing this business, there's a valuation associated to the pro rata share in the league. There's a valuation associated to the local market. There's actually a valuation associated to what else you can do in your given market, given the fan base. And so when you think about diligence, and the diligence that somebody would have to do is you really have to diligence all three of those things. And then on top of that, you have to diligence who's the team, meaning the management team, the ownership group that's going to run this business, that's going to capitalize on all of those things, because we are a minority investor.
Now, where does branding fit into that for individual teams? Let's say the Cowboys versus the Texans here in Texas.
Yeah, so I mean that really goes into that third component of like how much you can monetize your brand in your local market, and then any opportunities you might have to sell that beyond it. But the reason why certain leagues have a duration of profitability to them, like maybe the NFL or like maybe the NBA, is because there's more sharing that happens amongst them, right? Where more of the revenue is derived from a shared pot that then gets distributed out. And the Cowboys and Texans are a good example of that. Those are obviously two very popular brands in Texas, which has got a lot of popular football fans, et cetera. But that's really what it comes down to, is like you want to find a way to drive as much of the revenue through a shared pool, because then everybody wins together.
Now, talking about any investment, you got to talk about risks. So what are the risks that are typically involved with jumping into the private equity side of these ownership contracts?
Yeah, I think it's an interesting question. And certainly every investment does have risks. When I think about the risks of investing in sports franchises, and really risks of anything, the more concentrated of a bet you're making, the more risk you're going to be taking. So what's the concentration of the bet here in sports? Well, we're only owning sports franchises. So the biggest risk is, how much will sports continue to play a role in the culture and the fabric of, American society, right? Is the popularity in sports going to dwindle? And my answer to that is no, it's not. I'm sure everybody has their view of one league versus another. The reality is the ratings continue to be very strong for all of this. The viewership continues to be very strong for all of this, especially in light of the theme I talked about of cord cutting. If you go back and look at what's happened to linear broadcast television, ratings for every single effectively asset class or subcategory of linear television have been declining at basically double-digit rates for the last 10 years, except one: sports, right? And so the overall pie has shrunk, but sports have maintained the same nominal piece. So it's actually grown in market share of that pie. So the first risk would be, are sports going to continue to be popular? Yes or no? Then you think about, okay, well, that league that you're investing in, what's its popularity going to be? And how much risk is there around the relevance of baseball, hockey, football, basketball, et cetera? And then you get into, okay, that team, right? You kind of continue down the pathway of like the risk factors of you've got sports, generally speaking, that league, and then that team specifically within that league. And then there's that market, right? Is that market going to continue to be supportive of that local team, or will it have to be moved? And those are really the risks that, as we see them. There's the traditional risks of like interest rate risk, not really there. If you look at sort of how these investments have performed over the last 30, 40 years, we've seen rising rate environments, sports have done well. Declining rate environments, sports have done well. It all goes back to that low level of leverage they have. If you've only got 9% debt to capital ratio, then you're just not going to have much interest rate sensitivity, as opposed to a piece of real estate that's 70% loan to value.
Now, how long do you expect to be in on these deals? Most owners we perceive to be there for their lifetime, but what would you expect from a private equity side?
Yeah, I think this is what surprises people. And we've had enough experience now in other newer asset classes to see that sort of age-old principle of where excess profits are generated, dollars are going to flow to, and liquidity is going to increase. Like, part of the reason we're excited about the opportunity right now is that this is an illiquid asset class. Historically speaking, there hasn't been a lot of liquidity in it. And because of that, if you are a liquidity provider, you get paid for taking that risk, right? And we think over the next 5 to 10 years, liquidity is going to go up really for one reason. It's the one reason, the one that matters is because profits are going to be generated. People are going to want to participate in that. More transaction volume is going to come about. But that being said, there's actually a lot more M&A and transactions that happen in the sports world than a lot of people realize. Everybody only hears about the control market for sales. They think about, the Denver Broncos being sold in 2022, the Washington Commanders in 2023, the Phoenix Suns a couple of years ago as well. Those are control sales, but there's a whole minority investor market for this as well, where you can sell your interest in a minority fashion to another investor who wants to own a piece of it. And this is a number, this interesting statistic when you think about how deep is the buyer market for professional sports franchises?
Right.
If you go back, and this also goes to why do sports get such an incredible valuation? It's really a supply and demand function. Every asset is, right? It doesn't really matter what you're investing in. People say why does one investment go up versus another? It's one reason. There's more buyers than there are sellers. If there are more people want to buy than want to sell, prices go up. If more people want to sell than want to buy, prices go down. That's the only reason why anything happens. Here's an interesting number. In the year 1990, there was 105 North American professional sports franchises. 105, okay? There was 2.6 billionaires globally for every North American professional sports franchise.
My word.
2.6, right? So not that many.
Right.
Fast forward 34 years, right, to 2024, the number of North American sports franchises has gone from 105, I think, to 152 is the number. It's grown at a 1.2% rate per year. The number of billionaires is pushing 2,700. So the number of billionaires for every sports team has gone from 2.6, I think, to about 17.
My word. Wow. So
that's a supply demand imbalance that favors the teams. And when you think about it, if you're a wealthy person, and this doesn't matter if you have $1 billion or $1 million, right? Everybody has the same issues. People think that rich people, super wealthy people don't think these things through, and they just do whatever they want with their money because they have so much of it. I can promise you they didn't get there by having that opinion about things, and they're not going to keep it that way. Professional sports, going back to your question earlier in the call about, well, what's attractive about sports as an investment? It's the ability to compound capital at a very interesting rate of return with low levels of leverage and low levels of volatility and no correlation to anywhere else in your portfolio. Well, that's why wealthy people want to own sports teams. That's why the people owning them today are very sophisticated financial minds, is because I have the opportunity now to put capital, a large amount of capital, into something that I can have control over, not to mention all the social benefits of look, here in America, we don't have royalty, right? We don't have dukes. We don't have courtesans, none of that stuff.
Right.
The way we knight people in America is we let you buy a sports team. That's how it happens, right? So there's no quicker path to civic leadership in an area than owning one of the major sports teams in that area. You are instantly a community leader, whether you want to be or not, right? And so a lot of people want to have influence in their city. When you combine that with these other factors, it becomes a pretty attractive asset class.
Yeah, and these owners are holding on to them for a long time. But from the private equity side, how long do you expect to hold on to these teams when you're getting into these deals?
Yeah, I think so. There's the duration of the actual investment, and then there's some structural things that we've done to create a little bit more liquidity.
Yes.
I think that from the duration of the investment, this is a longer term investment. This is going to be, in our view, somewhere 5 to 10 years that we'll be involved in this.
So you're still thinking more like a traditional owner.
Yeah, possibly even longer. Now, what we've seen is that a number of the investments we've made to this point in sports have actually round tripped already in 2-3 years. So I think that will happen here, but we don't ever plan for that. But we've also done some things on the CAZ side of things in order to create more liquidity for our investors after just a couple of years. If they want to buy and sell, we have a mechanism for them to be able to do that.
Yeah, that's perfect. Now, I do want to switch gears really quick. I know we're talking about professional sports, but being a college athlete yourself, a college champion yourself, I would love to hear your thoughts on this discussion about private equity coming into the college sports world. I don't even know how that all meshes
Yeah.
together.
Yeah, this is something I followed personally for about a decade now as a former college athlete, um, and very much a former. That feels like a long time ago. Um, the I think interestingly enough, this has become the Wild West, right? The college sports landscape is in total flux, right? And you
Mhm.
might even call it disarray, frankly. It's kind of disappointing, in my opinion, to see what's happened.
Mhm.
And I don't mean that like everything that's gone on with NIL is bad. Ultimately, I'm pro players being more fairly compensated for the work that they're doing.
Right.
But I think the NCAA missed a great opportunity to self-regulate. I'll say that much. Now,
Mhm.
that being said, there's going to be a lot of opportunity to invest in college sports. There's going to be opportunities to invest in the conferences, right? At the big picture, think of that
Mhm.
as like the leagues. There's going to be opportunities to invest with the colleges in their own, assets that they have. And then also individually with players, right? I've already actually seen people who are helping finance NIL deals, and there's a return associated with that, player contracts, things of that sort.
Huh.
Um, but there's so much regulatory risk today because there really are no regulations, right? It's
Right.
yet to really be ironed out. The reason why we like just to sort of juxtapose professional sports and college sports, professional sports are exceedingly well regulated, right? There's very clear, bright lines around who can do what, when, where, how, right? That creates certainty for financial participants in that whole ecosystem to know here's what's going to happen if we do X, Y, and Z. There is none of that in college sports today. You have no idea. You could say, all right, I want to come in and I want to buy this. I want to invest here. The rules are changing. And because of that, it just creates more risk. So I would expect us to be a little bit more cautious there.
Mhm.
But interestingly enough, a college athletic department is really entitled to the same type of cash flows that a professional sports team is, right? They get
Mhm.
paid the same way. There's media rights deals, right? That they share in. There's local market revenue that they can generate through sponsorships and people showing up. So like they should be able to do the same sort of thing that the professional sports teams can do, albeit at smaller size because
Mhm.
the dollars just aren't the same, generally speaking, one to the other, particularly for one team within that.
Sure.
But it'll really be determined by can they get the regulatory environment figured out to give investors like us the certainty. Like we really look at investing in professional sports franchise as not that risky of an investment, relatively speaking, because of the structure in place.
Mhm. And college is kind of the same way because there is a lot of structure, but there's still a lot of the Wild West and the regulations that could come in that we don't know about. Is that what I'm gathering?
Yeah, it's just changing, right? There's so much that if you look at over the last 5 years, it's a little bit of a whipsaw as far as
Yeah,
you know
very
how
much.
the winds are blowing. Yeah,
And I think back to your earlier point, your ultimate customer is the fan, your fanatics.
yeah, yeah.
And what impact is the current situation having on those fans, those fanatics, and their drive to go and view these games? I think that's to be determined right now, but we'll see.
Yeah, I mean, I think in that note, done properly, this should be better for fans, right?
Mhm.
Like whoever the financial owner is, whether it's a university or a private equity firm or a person themselves, they understand that if the fan's not happy, if the fan's not having a good
Mhm.
experience, then they have financial risk involved here. And so I think any investment that happens is done to amplify the fan experience, whether it be give them capital to bring in better players, give them capital to improve the facilities to make it more welcoming and more enjoyable, more
Mhm.
family friendly, better corporate suites. All that stuff costs money, right? And this is sort of an interesting reason of like, well, why are sports teams selling a stake in themselves? Like there's an
Yes.
implication that like if they're selling, I don't want to be a buyer, right? It's that famous, I think, Groucho Marx quote about I don't want to be a member of a club that wants me to be a part of it type of thing. And that's
Yeah.
that same logic applies here. Well, you have to sort of invert that of like they want capital, they want something from us, and they're giving us something in return. And the capital that they're looking for is actually very valuable to them because when you think about all the projects that a professional sports team could do in terms of capital expenditures after a given season to do improvements to the facilities, the stadium, et cetera, they've got to make a list of all those things and they make a expected rate of return back on those investments. and they have to start crossing them off because they don't have all the capital to do all the things that they would like to be able to do. And a lot of that's because of the structural limitations on financing these businesses.
Mhm.
You have to do them primarily with equity, right? Very little debt. So you can't draw on loans to do this stuff.
Mhm.
And the equity, well, then you're going back to an investor base, a minority investor base that historically they're not there for the financial side of it. They've benefited from it, but a lot of folks just want to say they want to own a piece of the team. They don't like keep getting capital calls. So you end up with this like agent principal sort of a conflict where a control owner might want to make more investments and amplify a venue and grow the top line revenue because it's what they work on every day and it's their primary financial asset. But their minority investors might say, hey, look, I'm just a limited partner in this deal. I'm not really trying to put more
Mhm.
money into it. That's a bit of a conflict. And this is where institutional capital can come in and say, all right, we're going to help you clean up the cap table. We're going to give you more growth capital to do the things you want, and we're going to provide the operating expertise of the folks who actually know how to run these businesses, how to run these venues, how to negotiate media rights deals, all that type of stuff to help grow the businesses.
And then on top of that, you've got donors who are funding all this stuff previously. And so how does that fit into the balance too? I'm horribly curious to see this play out.
Yeah, I think a lot of the stuff we don't know yet, and so I'd be reticent to make a prediction. I think just thinking about it off the top of my head, you've got donors. Donors are the fans, right?
Yeah.
Donors have been the ones subsidizing all of this. All else being equal, I'm sure the donors would love to not have to give as much as they have been given, right? I
Mhm.
mean, I financially support the institution I went to, and I'm glad to do it. But like, if there's a better source of financing than me having to donate money, or at least, or it's really not
Absolutely.
one for the other. It's really additive. I'm all for that.
Yeah, absolutely. Well, Mark, this has been awesome. So, one final
Yeah.
question. What advice would you have? I guess maybe advice isn't the right word. What recommendations would you have for anybody who's interested in getting into investing in sports, particularly professional sports?
Yeah, I think there's really two mistakes that I see get made by investors that I would warn people against. The first is that when you think about the theme I've discussed here, cord cutting, the lack of correlation of professional sports franchises, the media rights, all this stuff, um, this is true of sports franchises. I see a lot of people who want to pull that and they want to put it into sports adjacent businesses like ticketing businesses and merchandising businesses and player management. And yes, they tap into that ecosystem, but they're not the same thing. So a mistake I see get made is that people say, "Oh yeah, I like investing in sports. I own these sports adjacent businesses, but not franchises themselves."
Hmm.
There's a very clear delineation around owning the content, owning the intellectual property itself of a sports franchise and the players on a field or a pitch or a rink or a court playing, and all the other businesses around that are competing for that content, right?
Hmm.
If you run a player management business, you're still competing for the right to manage those players, right? You don't own the players, okay? They can change that sort of thing.
Hmm.
When you own the franchise, it's yours. There's no other football league out there that's going to compete with the National Football League for football players. That's it, right? So the first mistake I see people make is like, oh yeah, I like sports, and they invest in like a sports adjacent business. And most of the time people do that because they don't have an opportunity to own a piece of the franchise because you
Hmm.
can't just walk down the hall, walk down to the local sports arena, knock on the door and say, hey, I'd like to buy a stake in the team. It's not available. So that's
Unless
the
you're in
first
Green Bay,
mistake.
maybe, right?
That's true, right? I actually had somebody in Green Bay tell me that yesterday,
That's
or in
funny.
Wisconsin. That was kind of funny. I said that's true, but you can't sell it, and there's no redemption on it, so there's no economic value there. So that's the first thing. The second thing I see people make is that when they decide to invest in a team, they think about I'm going to buy a stake in one team, in one league, and in one market.
Hmm.
And to us, you're taking on a lot of undue concentration risk on that investment because there's a lot of risks that come with owning just one team in one league and in one market that I think you can diversify away if you do it properly, right? And so I would caution people against saying like, "Hey, I have this thesis around sports. I'm going to pick one horse to ride on here." That's a lot of capital to bet, especially if this is a financial investment for you. If
Hmm.
you're considering it as a financial investment and not something that we're going to be actively involved in day to day. If you're going to take that sort of an approach, I can understand putting all your chips into onto one part of the
Sure.
table. But if it's going to be a financial investment, a passive investment, I really wouldn't do it concentrated in one way. I think about levels of diversification across leagues, across different geographies, and across different teams within one league.
Mark, that's terrific. Thank you so much for joining me today. Really appreciate your tremendous advice and insight, and certainly wish you all the best at CAZ.
Thank you very much. It was a pleasure to be here, Matt. Have a good one.
We hope you have enjoyed this episode of The Alternative Investor. If you found this valuable, please be sure to like, subscribe, and share. This show is brought to you by Honey Hive Capital Partners. Visit us at honeyhivepartners.com to continue your alternative investment journey. This recording represents the views and opinions of its guests and does not reflect the views and opinions of Honey Hive Capital Partners, LLC. Nothing in this recording, nor any communications from it, should be treated as constituting financial, investment, legal, tax, or other advice of any kind, or as a recommendation to buy or sell an interest with respect to any investment. We look forward to you joining us next time.